All righty. Hello, everyone. Welcome to After the Close. My name is Barbara Armstrong. I'm a coach and senior manager with Charles Schwab. And today we're going to talk about, it's similar to last week, how to potentially generate income, or one of the ways an investor might choose to generate income in an account where they are doing most of their trades after the close. And, in this class, what we're looking at is a portfolio that we're trying to build where we started with a modest amount, $1 million that we theoretically inherited, and we don't have time during the trading day to be watching the markets and doing a lot live with the markets. Maybe we have a family, we've got a yard to take care of and kids to get to lacrosse and hockey and soccer and dance or whatever it is, or we have a full-time job, one of those pesky jobs that keep us from looking at the market. And so our time to look at the market might be at 8 o'clock or 9 o'clock at night. And so we're looking at what types of strategies, what might we use? And today we're going to talk about part 2 of buy right covered calls, which is what we talked about last week. And so we're going to place some new example trades, and then we're going to look at, how we might have a routine to manage our portfolio. And so those are the 2 things we're going to focus on today. I never eat here wins the prize for being the first one into the chat today, followed quickly on his heels by Long Snapper, and then Frankie and Jay and the rest of the gang, Kevin and Ricebird. And I really appreciate you all being here and bringing energy to the class by being so participatory in the chat. We also have my friend and fellow coach, Mike Fairborn, with us today. And if you aren't following him on X, you're missing out. So I encourage you to do that, Mike Fairborn CS. I'm also posting content on a daily basis. It's another way for me to communicate with you and you with me outside of a webcast like this. So my handle at Barb Armstrong CS, we invite you to follow us there. And just before we get into things, know that options carry a high level of risk. Just hold 1 second. Okay, sorry. I just had some background noise. I wanted to be sure wasn't interrupting us. So know that the strategy we're going to talk about today involves both buying stock and selling a covered call, and know that options carry a high level of risk and aren't suitable for all investors. Also know that we use the Paper Money software application. That's where we have built our example portfolio, and that's where we'll be placing our example trades today. And that is part of the Thinkorswim desktop platform. It is a brilliant place to learn. Now, one of the nuances or differences between that and a regular live account is that short options will never be called out early. And so we know that. And with both stop market orders, in a live account or in a Paper Money account, if the stock gaps down, it's not a guarantee that we're going to get out at exactly the price we requested. And with a stop limit order, we might not get out at all. And so, stops can be a beautiful thing, but they also can have their limitations. Okay, so let's get out and have a quick look at the platform. Sorry, I'm just scrolling down so that I can make sure that I see any questions as they come up. And I want to kind of look at a couple of different things. So one, we started with $1 million. We're down just a smidge from where we started. But when we look at the S&P 500, we kind of came a long way back. And, just until the final moment, this actually was it kind of went up and down over the course of the day. But this was a bullish candle until the last couple of minutes of trading. But this inverted hammer pattern is what this is called here, is an indication that, this pullback may be coming to a close. but this pattern also needs confirmation. And if you're new to technical analysis, I will show you in a few minutes some quick videos that you can watch on that. So, we've come up a long way. Like when we look from here to here, that's a 23% move since the beginning of April. So we're kind of on our way back. When we look at the NASDAQ, it's pretty similar, isn't it? And we finished again with this inverted hammer type pattern on the chart today. And, we're now almost at par for the year. I mean, we're not, we're down 0.5% on the S&P. We're still down 1% year to date. So, after such a robustly bullish year last year, that's kind of a little hard to take. And the Russell is still down 8%. And again, this big move to the upside, and then we've had a couple of days of pulling back. Our Dow, similar type of pattern, right? And, we had this big dip and it's come back up. And right now it's sitting on a support level that it's visited, a few times in this past year. And our volatility index, which is the VIX, that is still, it's hanging around 20. So it's come up a little bit in the last couple of days, which is what we'd expect when the market has pulled back. But, after the last month and a half, this is looking positively pedestrian, isn't it? Okay. Now, I want to show you another index and, another piece of information. It's SPX $SPX A50 A50R. And this is the percent of companies that are in the S&P 500 that are trading above their 50-day simple moving average. And when we look at that, even though it's pulled back, it's at 61%. So, over half of the companies in the S&P 500 are trading above their 50-day moving average. Now, 2 days ago, that was at 78%. But, that's a relatively, and it's a relative number, but it's a relatively bullish number, isn't it? Okay, so let's come and look at a couple of examples. So Palantir is one, and this is a tech stock. If we come to the Analyze tab, we can see here that it's in the tech sector, company based out of Denver, Colorado. And, it's been around for a little while, because we've got 5 years worth of data here. But, when we look at the chart and we see, it's gone from $20 up to $130 a share, and it's pulled back, and had a pretty significant beat on earnings. And it's pulled back, and this candle pattern would indicate that this pullback is complete. Now, no candle pattern is a guarantee, but this pattern is called a Harami pattern, and technically doesn't require confirmation. So if we were to buy 100 shares, and the idea of a buy right covered call, and you can do this for a couple of different reasons, but we're thinking about using this as a dating strategy. And what do I mean by that? Well, what I mean by that is saying, like, hey, I'd like to hang out with you for a while, but I'm not going to put a ring on it. I'm not looking at this as a long-term love affair. I'm in this. We're on the other side of earnings. We're going to give this, maybe a month, and I'm going to sell maybe this one. The recent high was 133. I'm going to sell this. Why is my drawing tool not working? It's frustrating. Oh, there's my line. Okay, I'm going to sell this 135. I don't know why this is so delayed. Is that going to show up now? Okay, guys, I'm going to just shut this down. So I'm going to just use my drawing tool here, which wasn't what I was going to do, but So the idea is that we're just going to come in here and we are going to sell a covered call. And we don't own the stock, so we're going to buy the stock at the same time. And we do that, we're buying the stock and we're writing a covered call at 135. And then the goal is to get run over. So the goal is for this to go up through our strikes and for us to end up being called out. So that's the goal. Okay. So let me see if I can draw a line now. Oh, let me get rid of those. So the goal is for this to go up through our strike. Now, if it goes up and then pulls back a bit and ends up, at expiration below, then we get to keep what the credit that we got paid. And we also get to keep the stock. And then what might we do the next time? Well, maybe we come out here and we sell a call at 140. Now, if it maybe pulls back and then by expiration, it's through the 135 at expiration, we would in all likelihood be called out. The percentage is very, very high. If it's in the money at expiration, this covered call would be exercised and we'd no longer own the shares, but we'd have made whatever that return is. Okay. And so this is not a long option. This is a short option because we're selling. Selling means short. We're selling a covered call. Now, if it pulls back, can we buy the covered call back at some point? We could. And there are times when we've done that. So let's say this comes up here and then comes back down around this level just prior to expiration, we might buy that call back. Okay, so let's just see if it looks like this might be worth it for us. So if we come to our trade tab, and this is called on the Thinkorswim platform, buying covered stock. And so one of our rules, and we do have an example trading plan for this, is does this stock trade more than 1 million shares a day? Because we want to look at stocks that are heavily traded. And then when we come out to that 135 strike, is there a lot of activity for this stock at this strike, at this expiration, which is June 20th? Well, we have 10,000 contracts on the books and another 2,300 that were traded today and a 10-cent bid-ask spread. And what these columns are telling us is that at this 135 strike, we have a 25% chance of it being in the money based on where the stock is currently trading, and a 50% of it at least coming up and kissing it or touching it at some point. And so, we have a 75% chance currently, according to this, of getting to keep this credit, and this might expire worthless. But of course, if this stock goes up as we're expecting it to, the value of this call might go up and we could end up being called out. And you can be called out at any time from the time you place the trade until expiration. And, and so if that happened in our case and we were doing this as a dating strategy, would we be sad? No, we have received our max gain, sooner. So we're going to come here, look at this covered stock, which is how it's phrased on the Thinkorswim platform. So what's the most we could make? Well, if we come over here and we look at our calculator and we say, well, the most we can make on this is if we get called out at 135, and what are we, paying to get into this trade? 118.85. So the most we can make on this is $16.15 a share, or $1,615 per contract. And if you don't want to do that math, if you come to confirm and send, it'll tell you right here, your max profit, 1613. Okay. So if now, how much are we risking? Well, we're risking the entire amount we're paying to get in unless we put some kind of stop in. And so we might say, well, I'm going to put a stop in 3% below yesterday's low. That's 119.41 is yesterday's low. And 3% below that, 119.41 times 0.97. Okay, 115.82 will be our stop. Okay, so we are going to come to our trade tab and we're going to come to our single order, make it a first trigger sequence. And last week we had, or earlier this week I had some issues. So hopefully we won't have any issues this afternoon. I'm creating an opposite order. I'm going to make this a market order that is good till canceled. And I'm clicking on this little sprocket and then it brings up a conditional order because we don't know quite what this call will be worth when we have to buy it back. So, but we're saying, hey, if Palantir goes below 115.82, we'd like to exit the position. And the idea here is that we're making a decision on when to exit the trade before we get in, when we're calm, cool, and collected, and we're not letting fear or FOMO influence our decision. And then with this account, because it's $1 million account, we're saying any one position size can be up to 5% of the account value. We could do a $50,000 up to a $50,000 position. And at 118, this is 12. So we could do 3 contracts. And how much would that be? It would be 35,000. In fact, we could probably do 4 contracts. Let's see what that would be. So that'd be 47,000. So that would meet that position sizing requirement. Now, if we got stopped out at about 115.82 and we're paying 118.79 to get in, this is just an approximation. We're risking about $3 a share. And so, and again, there's not a guarantee we'd get out at exactly this price, but if we're risking, that means we're risking about $1,200. And in this account, being $1 million account, we were willing to risk up to 5,000. And so we're going to put this in our buy right category and we're going to send that in. And then I will check tomorrow morning and make sure it gets filled. And I owe you guys an apology because we did a trade last week. I owe myself an apology. And we were going to sell a covered call here on Rivian. And it went up a little bit the next morning and and the trade expired. And so it didn't get filled and we would have done very nicely on that trade. And so we didn't get in. So maybe we look at that one, again next week. But, I will check tomorrow to make sure that we get in on that, on our Palantir trade. And so this is one of those, you teed it up. So now when we look at our pending orders, we can see this order. But, if it goes up a little bit when the market opens, we might have to just go in and cancel and pay a few pennies more. And if that's the case, are we willing to do that? We are. And, and again, if we come back to our trade tab on Palantir, and we look at that position where if we were willing to pay 118 and we could get out at 135, so let's round up, call it 119, that's, up to a $17 gain, right? 119, 20, 16, let's call it $16 gain potentially on a $119 investment, and I'm just rounding up. That would be a 13.4% return. and that's a pretty handsome return for a return. That's our theoretical max gain on that. But, that's at the very high end of what one might expect to see. Okay, so let's look at another one. And this one is Boeing. Boeing's, it seems to me Boeing's always in the news. But when we look at this stock, it was kind of on the struggle bus for quite a while. When we look at the last year, right? And then it seemed to break out. And now they've got a big order from China for planes. And, look at how far this has come since this bottom here back on April 7th, when a lot of things in the market hit their bottom. And you might say, well, have I missed it? Well, this maybe, again, dating strategy. Maybe we don't want to buy and hold this forever. But could we look at this and say, we have kind of a bull flag in what we call a stiff wind where it's been going sideways? And could we maybe come out here and just sell the 2010? Like it's kind of like a swing trade with the idea that, and we'll put this in here at 210. And this is our buy right. So that when we look at our chart, we kind of know what we're aiming for. The goal is for it to go through here and then stay above it and we get called out. And if we don't, and then if you say, well, here's our low. If our low is 201.85 here, if it goes 3% below that, this isn't our expectation. Our expectation is that it's going to go up. And so if it goes 3% below that, I already did the math, that would be 195.79, then we would want to get out. And so if we come to our trade tab, again, we're going to come down to June 20th. We're going to come to this 210 strike. Does this trade more than 1 million shares a day? Yes. When we look at this 210 strike, and let me just draw a line here so it's easier for us to see. Do we have a lot of contracts? Well, over 11,000. How about the bid-ask spread? Even in the after hours where the bid-ask spread tends to be wider, that's 10 cents, which is, and we're saying if it's less than 10%, we're okay. That's acceptable. We have a 34% chance of being called out, a 70% chance of it coming up and hitting 210. And of course, these are fluid numbers. Like if Boeing goes up tomorrow, these numbers will change, right? Okay. So next question is, is it worth it? Is the juice worth the squeeze? Okay. So, sorry, I've got to close my drawing tool. Okay. So we're looking at buying covered stock. So if we, 199, 210. So if we say, okay, the most we can make is the difference between what we're paying to get in and this strike. So that's $10.69. So if I can make $10.69 on an investment of $199.31, what kind of percentage return is that? 5.3%. for a trade that we would be in for up to 29 days. Now, we could also end up stopped out on this, and we're going to put our stop in around 195. So we're risking about $4-ish a share. In fact, a little bit less than that. So we're going to do 2 of these because that would be a $40,000 investment. Single order, first trigger sequence, right click, opposite order. We're going to make it a market order. That's good till canceled. And then with our conditional order, we're going to say, hey, if Boeing goes below 195.79, we'd rather exit and maybe reconsider this position later. We're going to take our lumps. So this is a $40,000 position. Is that less than 50? Yep. So we're okay position sizing wise. We want to exit if Boeing goes below 195.79. It's currently trading at 203.41. So that gives us, $7 and change worth of wiggle room. We're buying 2 covered calls and 200 shares of Boeing. And we're going to put that in our buy right group. Okay. Fire in the hole. Now let's look at a couple of our positions. And if you're doing a weekly routine, it's 9 o'clock at night, you're sitting down with your cup of herbal tea or a beer or whatever it is, you're saying, I just want to make sure I have my positions protected. You could see where your stops are on the chart. And we say, okay, well, for growth stocks, we've got 4. And we're up on all of them. The 2 of them I think we just put on recently, and we're not up much on those, but Meta, we're up by almost 10% in this. And one thing about these are unrealized gains, and what the market giveth, the market can taketh away. And this is why we want to have protection. And then on Deere, we have nothing. So what we're going to do is come out to the charts. We're going to come to our sprocket, and we're going to say, show our orders. And what that'll do is it'll show us our stop loss order. So when we come to American Express, we can see that this is where our stop loss order is. And we might say, you know what? It seems to me that this is acting as support. So I'd like to move my stop up here to, 3% below that low. So you could say, okay, well, that's 285.07 times 0.97. I'm going to move my stop up to 276.51. And our stop is currently at 265. So we're just going to click and drag. We said we want it up to about 276. There we go. And if you wanted to, if you're saying 276.16, that's close enough. If you want to get really specific and make it 276.51, just come in here. Bada bing, bada boom. And we've adjusted our stop. And then we go to the next one. And this doesn't take long, and you might do this once a week. You might do this once a month. And again, when we bought this, we put our stop, it may have been 3% below here. And you may have said, well, it looks like this is now holding as a support level up here. And so I'm going to put my stop 3% below that. And if you wanted to move that up, 78.41 times 0.97, that would be 76.05. And we're at 72.94, so we could move it up a little. 76, 02. And if we're saying, okay, that's close enough, we're going to send that in. Now, we also have a trade on Meta. And instead of putting a target, we just said, hey, if this gets up to the previous high, this is an alert that is saying, hey, do we take the money and run? Or do we consider staying in the position? And when we put this on, we put our stop maybe 3% below, this level here. We might now say, well, I see this holding as a support level. This seems to be working as a support level. So maybe you want to move your stop up. And if we got in at this price, then this goal might be not only to define our risk, but an attempt to protect some of our profit. And so if we look at that, 620 87 times 0.97. That would be at 602. And where is our stop now? It's at 525. So we're trying to basically eliminate $75 worth of risk or protect $7,500 worth of, well, actually, it's eliminating that much risk. 602. And we're going to edit that in our, and you know, these are ranges. So you might say, you know, 601.74 is fine. 602.24, because, you know, support and resistance are ranges. Okay, why did that not come up? 602, edit. Okay. 602.24. Confirm and send. And so we've just replaced our stop market. Now, some people think that stop markets last forever, and they don't. Now, with Deere, what we had done was, I think we had a protective put over earnings, perhaps, and now we're on the other side of earnings, and that protective put has gone away. And, you know, we're looking at, you know, a bit of a profit here. And so where might we put a stop? Well, we might say, well, it seemed to have come up to this support level a couple of times and then it broke out. So what if we put our stop 3% below that 509-ish level? So 509 times 0.97. And I'm using 3%. You could use 5%. You could use 2%. You know, that's just an example. And so with this one, we don't have a stop in place. You know, so we are going to right click, create a closing order with a stop, and we're going to make that 493.73. 493.73. And make that good till canceled. And so there's our stop. And now you'll see when you come here that there's a little chiclet beside each one. And you know, also you'll notice we paid $4.79 a share to get in, and now our stop is at $4.93. So we're attempting to try and protect some of our gain while giving it enough room to grow without, you know, enough rope to hang yourself, as my dad would have said. Okay. And then on these dividend stocks, we don't have exits either. Now, all of these pulled back, and I'm not going to take the time to do every one in this class, although you could do them pretty quickly. So if you come out and you look at Altria, for example, which is MO, and if you say, well, I want to be in this for the longer term, you may come back to this low here at 56.06 and say, I'm going to put my stop 3% below that. And so you'd come to your 56.06 times 0.97. 54.37 is going to be our stop. We're going to come to our trade, or sorry, our monitor tab. And again, we're going to right click. And the advantage of doing this, you know, from our monitor tab is that it makes sure it brings up the right quantity and all of that. And 54.37. Now, a stop loss after 6 months, I believe it's 6 months. It's either 90 days or 6 months. It's 3 months or 6 months. They expire. And so, you know, I think it's an important thing to either weekly or at least monthly go in and just make sure, like I call them little chicklets, that you see these little orders, which means you have defined an exit and put a stake in the ground. You know, and if we wanted to do one more and we looked at AT&T. So now we can see our stop. Now, AT&T is where we had this protective put. And we might say, well, if I'm looking at this from a technical perspective, and I'm going to get rid of this line too, what I'm currently seeing on the chart is a bit of a pennant pattern where we're seeing some lower highs, but higher lows. And so if we said, well, I'm going to look at this low here, and go 3% below that. So if it breaks below this pennant, then we're out. So we're going to put our stop around this 25.51. So sorry, I'm going to come back to my monitor tab. We have 1,000 shares, which sounds like a lot, but it's a $27,000 position. We could have a position, we could buy another 500 shares and we'd still be, under our max position size for that. We're going to make this 25.51. And so stops can be based, we can create support and resistance levels or recognize them different ways. Ted is saying when a GTC order expires, you get a notification. I wasn't aware that that happened. So that's really good to know. But, I was talking to a client, this was many years ago, and she had a really big position in a stock. And some family things happened and she wasn't paying attention to the market and her stop expired and she didn't realize. And then that stock really took a big hit. And she thought she was out. So she wasn't even checking her portfolio. And it was a very expensive learning opportunity. Let's put it that way. And so I'll go ahead and I'll look at these other two and we'll put those in. Verizon, we're going to put that one at 40.98. So here's another one where we had a protective put over earnings and it pulled back, but that protective put is now gone. The covered call is now gone. And again, if we want to come and look at this and say, hey, we're going to go 3% below this line here, that would put us at that 40.98 level. In fact, we may make it like 40.78 because sometimes things will come down to a big round number like 40 and it may nick just below. So we'll make it 40.78. And we'll make that good till canceled. And sometimes like you're thinking like, I was sure I put a stop in, what happened to it? And it may be that you just forgot to change it from a day order to good till canceled. Okay, now if we come to our buy right group and we look at Triple M, we see a quantity here. And the reason we see this quantity is because we no longer have a covered call. I think we bought it back. And so we bought this stock for $153. We're down $700 on this. We have 200 shares. It's currently trading close to $150. And I just wanted to bring this one up because I think we talked about this last week and said, it had come up, but we were waiting for it to come back up close to this resistance level. And then we were going to sell another covered call. And unfortunately, we only meet on Thursdays. And so what was the date of our last class? The 15th. So here, it was sitting right here. We're not that far from it actually, but it did go right up where we were expecting. And now it's come back and we have both, a candle pattern that might indicate this pullback is complete. We also have, this is considered to be a Harami pattern. So, we're going to wait and see if this goes back up and then we'll sell another covered call at, or maybe around this 155. And if we come and we look at Triple M, which I didn't do ahead of this class, but let's go just have a peek. We put this on that long ago. Let's go 150 days. Okay, so we were paid $3.25 for this first call, and we bought it back for 50 cents. And so, you know, the $2.75 that we were ahead on this isn't showing in this number here. But what we'll do, and I'm going to be away next Thursday, but what we'll do is we'll watch this. And if Triple M goes up, we'll add another cover call. So, and I'm not sure who's going to pay, who's going to be filling in for me, but yeah, maybe I'll just give them access to this account and you know, they can go from there. Okay, so let me just look at the questions here. Will our stock get bought in paper trading if the price goes up past the strike? So if, let's say right now we did this 155. We sold a 155 call and news comes out on Triple M and it goes up to 160. In paper money, will never be called out early. In a live account, we might be, but often we're not. Even if it's in the money, often we are not called out ahead of time. And for some people that's confusing. It's like, hey, my strike is in the money. How come I haven't been called out? How come I still own this stock when it's trading above this strike that I sold? It doesn't mean you will be just because you might be. But if you don't want to sell the stock, which sometimes people sell a covered call to make some money on the side and they don't really want to sell the stock, you have to know that you could be called out. Yeah. Okay. So we just have a couple of minutes left. I wanted to show you a couple of things. So one of the things I wanted to show you was, just a sec, let me come here. So I wanted to show you these trade management mini sessions. So I talked about an example trading plan, and here is an example trading plan for a buy right covered call. If you haven't subscribed to this channel, you'll want to do that. So here's an example trading plan for a buy right covered call. It's in the trade management mini session playlist. And these are all the trading plans have a blue thumbnail. And then if you come up here and you're saying this candle stuff, you know, I'm still getting the hang of it. I've created a bunch of short videos and more to come. But, you know, I've got the first half dozen here and there you go. So you could just watch, like they're 5 minutes. You can just watch these, you know, binge them like you're eating Cheetos, right? Yeah, so that's available to you there as well. Okay, so you're going to want to hit the subscribe button. If you haven't already hit the like button, it not only lets Mike and I know that you found this content valuable, but it also, you know, helps move this up in the algorithm so that more people can find this content. So hit the like button, hit the subscribe button. I don't know if there was a survey posted in the chat today. I did not see one. So I think you guys are off the hook on that. But if you would follow us in the, oh, there is a survey actually. So sorry, you aren't totally off the hook. But, you know, here's the deal with the survey. It's 2 questions, and I've just reposted the link. It's 2 questions, and it's 1, I hated it, 10, I loved it, and I'm coming back next week, and everything in between. And so, and you have the ability to put comments in. And my promise to you is if you fill it out, I'll read each and every comment. And your comment might be like, you haven't talked about this topic lately, would love to see this topic, or I'd like to see more examples, or I'd like the pace, or pick it up, or, you know, whatever. So you have a voice. And if you're watching this in the archives, you too have a voice. You can just type your requests into the comment section down below, or your ideas. And I do look at those on a daily basis as well. So if I don't see you tomorrow for trading a smaller account, get out and hug someone you love. Have a wonderful Memorial Day weekend, and I will see you in a webcast coming up soon. Thanks to Mike for his work in the chat and the guys behind the scenes for helping bring this to life. Take care, everyone. Bye for now.